Imagine waking up tomorrow and discovering that credit card debt across America has reached a breaking point. Not just high, not just difficult, but flat out impossible to repay. Every household drowning in balances, every statement arriving with interest so crushing that even the minimum payment is out of reach. What would happen to people, businesses, and the economy? Let's start small. Ordinary families. In the US, the average household already carries thousands of dollars in credit card debt. Many juggle payments month to month, barely keeping up. Now, picture that debt ballooning, with interest rates shooting into the 30 to 40% range. Suddenly, no paycheck is enough. Families would have to choose between groceries, rent, or making a payment that no longer reduces their balance. Financial stress would skyrocket. Millions would default, not because they don't care, but because repayment has become mathematically impossible. Next, the banks. Credit card companies make money from interest. But if people stop paying, their entire business model collapses. A wave of defaults would ripple through the financial system. Smaller banks could fail outright. Larger institutions might need bailouts, much like in 2008 during the housing crisis. But unlike mortgages, credit card debt is unsecured. There's no house to repossess. That means lenders would be left holding trillions in worthless promises. The effects wouldn't stop there. Retailers would feel the hit immediately. Credit cards aren't just debt, they're also spending power. Americans swipe their cards for everything from coffee to medical bills. If cards were maxed out and banks froze new credit, consumer spending would plummet. And since consumer spending makes up nearly 70% of the U.S. economy, the slowdown could trigger a full-blown recession. Stores would close, jobs would vanish, and the cycle of crisis would deepen. On a personal level, the psychological toll would be enormous. Debt already causes anxiety and depression for millions. If repayment were impossible, that despair could spiral into hopelessness. People might give up on trying to build savings, buy homes, or start families, believing the system is rigged beyond repair. A generation could grow up viewing credit not as a tool, but as a trap. Governments would face an impossible choice. Do they bail out the banks again, risking public outrage? Do they wipe out debt directly, effectively resetting the system? A mass debt jubilee might sound appealing, but it would also punish savers, investors, and pension funds tied to credit markets. Inflation could skyrocket as trillions in vanished debt suddenly free up spending. Of course, not everything would be doom and gloom. A crisis of this scale might finally force real reform. Politicians could introduce stricter lending laws, cap interest rates, or push for alternative systems of credit. In the long run, the collapse of unpayable debt could spark innovation, new payment technologies, decentralized finance, or even universal basic income programs to replace reliance on credit. So what's the verdict? If credit card debt truly became impossible to repay, America would face a financial meltdown on par with the Great Depression. Families would suffer, banks would wobble, and the global economy would tremble. But from the wreckage, we might also see the birth of a new financial order, one less dependent on plastic cards and compounding interest, and more focused on stability. Until then, the best defense is simple. Use credit as a tool, not a lifeline. Because if the day ever comes when the bill is too big for anyone to pay, the entire system could collapse under the weight of its own promises.